Hey everyone, welcome back to Corporate Decoder, the place where we help you decipher the confusing world of corporate finance without the confusing jargon. Get ready, because we're diving into a report that might seem a bit dry at first, but holds some seriously interesting nuggets about how our money works in the real estate world, especially concerning what you might get back as dividends. Alright, so what we have here is a Form 8K filed by NNN REIT Inc. Now, this isn't a regular quarterly or annual report. It's a current report basically saying something important happened that shareholders need to know about right away. Think of it like a company's way of sending out an urgent bulletin. The main reason NNN REIT Inc. is filing this report is to tell everyone about some new laws that are going to affect how they handle their money and how you as investors get paid. It's all about taxes, and that's always a big deal for any company and even bigger for us as investors. The date here is August 15, 2025, and that's important because it tells us when these changes are considered to be officially in play. Now, NNN REIT Inc., like many real estate investment trusts or REITs, they own and operate income-producing real estate. They're known for their vast portfolio and their common stock trades on the New York Stock Exchange under the ticker symbol NNN. This report is all about changes to certain tax rules that affect NNN REIT, specifically how their dividends are treated for non-corporate shareholders and how they manage their investments in what are called taxable REIT subsidiaries. The core of this filing focuses on new legislation that modifies disclosures about material federal income tax considerations found in their prospectuses. That's a fancy way of saying the company has to explain the tax implications of investing in them, and this new law changes how they explain those tax implications. Let's break down what this new legislation actually means for you. The first big change is pretty exciting for many investors. This new law makes permanent a 20% deduction for ordinary dividends received by individual investors. Before this, there was a chance this tax break would disappear at the end of 2025, but now it's here to stay. So if you own NNN REIT stock and you're not a corporation, you can typically deduct 20% of the ordinary dividends you receive. This is a significant benefit, making dividends from REITs like NNN even more attractive compared to other types of investments. It's like getting a 20% discount essentially on the income you earn from your REIT investment. The second change is also important, and it's about how NNN REIT manages its internal investments, specifically its ownership in taxable REIT subsidiaries or TRS. These are essentially entities that NNN REIT owns which are taxed as regular corporations. Now there's a rule that limits how much of a REIT's assets can be invested in these TRS entities if those investments aren't considered real estate assets themselves. Currently, there's a 20% quarterly limit on this type of investment. However, the new legislation is raising this limit to 25 starting January 1, 2026. So what does this mean in plain English? It means NNN REIT has a little more flexibility to structure its business operations. They can potentially channel more of their investments into these taxable REIT subsidiaries without running afoul of the rules. This could allow them to engage in a wider range of business activities or acquire different types of assets that might be held within a TRS. For investors, this could indirectly benefit the company by allowing for more strategic growth and potentially higher returns if these expanded opportunities are managed well. However, it also means NNN REIT has more freedom to shift assets potentially into lower taxed corporate structures, which is something to keep an eye on as the company grows. The report is signed by Vincent H. Chow, who is the Executive Vice President and Chief Financial Officer. This is his official stamp of approval, saying that the information presented is accurate to the best of his knowledge. Looking at the bigger picture here, NNN REIT is navigating changes that directly impact shareholder returns and corporate strategy. The extension of the 20% dividend deduction keeps REITs competitive for individual investors. The shift in the TRS asset test allows for more operational flexibility. Now for my take based on this. The good news is the permanent extension of the 20% dividend deduction is a clear win for all individual investors in REITs, including NNN. Makes the income stream from these investments more tax efficient, which is a strong selling point. The increase in the TRS asset test limit to 25% is a more nuanced development. It offers NNN REIT greater strategic maneuverability and could open doors for new ventures or acquisitions. Inherently bad. It's something investors should monitor to ensure it aligns with transparent wealth creation creation for shareholders rather than just tax optimization for the corporation itself. Acquisitions, however, which also gives the company more scope to manage its tax liabilities internally through these subsidiaries. While this isn't inherently bad, it's something investors should monitor to ensure it aligns with transparent wealth creation for shareholders rather than just tax optimization for the corporation itself. In essence, NNN REIT is setting itself up to be more agile and potentially more profitable by adapting to new legislation. The market reaction and the company's subsequent actions with this newfound flexibility will be key indicators of its future success for investors. Alright, that's our breakdown of NNN REIT's latest filing. What's your take on these changes and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.